This episode of Bulletproof Cash Flow is brought to you by Realty Dynamics. Learn how people like you can build substantial passive income while creating wealth for the long term through real estate investing. Visit rdyne.com. That's RDYNE.com.
The most interesting thing that was presented by COVID was how the government worked with the markets, how it moved into markets. And like you said, the difference that we saw based upon state was dramatic, to say the least. And it's why we've seen such massive capital flows leaving places like New York or California. And when we looked at this, we look at this capital flow, we look at the migration of people, we look at the growth rates that are caused from it. The areas that we had self-storage exploded.
Working because you want to, not because you have to, is financial freedom. And we want to help you create that. Welcome to the Bulletproof Cash Flow Show. We're going to teach you how to achieve lifetime financial freedom through real estate investment. Your host is a multifamily syndicator and property developer. He's done deals reaching into the hundreds of millions of dollars. You'll hear from experts in all aspects of real estate investment, finance, development, and management. Everything you need is right here. This is the Bulletproof Cash Flow Show. And this is your host, Augustino Pintus.
Hey everyone, it's Augustino. With cap rate compression that we've seen in the multifamily space, people are looking for solid and safe returns. And self-storage is one of those asset classes. Now, the world of self-storage has changed a lot over the past 18 years. Now, since the 2008 crash, investors have had incredible opportunities to turn around underperforming businesses or convert these unused properties into this more in-demand asset class of self-storage. Now, our next guest knows all about this. He has become one of the world's top 70 self-storage operators. He specializes in buying and turning around underperforming self-storage facilities with a value-add strategy. Now, to do this, he created a management company to run his facilities and to focus on growing his portfolio. Today, he owns and manages a self-storage portfolio of over $100 million in assets. Now, additionally, he's author of the best-selling book, The Investor's Guide to Growing Wealth in Self-Storage, and he's also the host of Self-Storage Income, the #1 podcast in his field. Now, with all that, I'd like to welcome AJ Osborne to our show. AJ, buddy, thanks for coming on, man.
Thanks for having me. I appreciate it.
You bet. Now, guys, like AJ has to say, you can reach him via the contact page at selfstorageincome.com. Okay, AJ, go ahead and tell listeners about your journey.
Yeah, so, obsessed with self-storage, got into it a long time ago, though. And when we first got into it, didn't know that we would be in it like the way we are. We were looking for diversification of income, and we were looking for tax benefits. I was an insurance salesman. That's what I did. I sold health insurance. And I didn't really want toilets, and I didn't really understand multifamily and things like that. So I really got business. We ran sales businesses. I did M&As. And for us, when I looked at self-storage wasn't a real estate asset class. It was a business. It's just the people that owned it didn't know what they owned. And we had a thesis that we could buy these businesses, focus on revenue management and actually running it in the form of marketing and all sorts of different stuff. And we could dramatically improve the revenues and cash flows of these businesses. And we did really good. It was, it was kind of hard when we started out because it's not like today. Like when we got started out, banks didn't even want to finance self-storage because they viewed it as a very risky product type. And a lot of the United States didn't utilize self-storage. They didn't understand it. Investors didn't want it. Real estate investors didn't want it. It was viewed as a junkyard. And the underlying economics, I don't believe, supported that. But we liked it because it had a lot of cash flow. It had good, healthy cash flow. It had margins. But more importantly, it had cash flow that I could change. I could have an effect on the underlying cash flow. And that was very, very important to us. So we kept in it, and we built an entire company around one thing: extracting yield. And that was the sole purpose. I didn't know anything about cap rate compression. We were never buying to flip or anything else like that. I really didn't even understand how beneficial equity is and refinancing and none of that. It was just, we're buying, we're owning forever. All we want to do is increase the revenue. And we became obsessed with it. We invested millions into technology later on. We have a company over 60 employees. We did dynamic pricing like airlines to figure out, how do I get more revenue out of this asset? Because we didn't have investors when we started. So that asset had to produce cash flow. It had to pay us, and had to give us cash flow to reinvest back into our business, not the asset, but the actual business that ran the asset, as well as buy more assets. So, 8-10% return doesn't cut it when you need what we needed out of that asset. So we invested a huge amount of money into finding and really optimizing this asset class. And, we're approaching almost 20 years now doing this, which kind of blows my mind. And a lot has changed in this industry since then. I don't think anyone thinks of self-storage as a junkyard anymore. And it's gained in popularity in ways that we would have never foreseen and couldn't have understood. And that really helped us, though, as we grew, because I was putting out lots of information on it. I was like, there's no good resources for information. So I thought, well, I'll just make it. And made a book that I said is a good book. There were some books out, but nothing that was really worthwhile at all. So put out a book, everything, and it just kind of compounded from there. And we've been riding that wave. But it's not as easy as it used to be, right? It's a lot harder, and the game has changed. I think we were very, very fortunate to get in when we did and have the cash flow and assets that we had to reinvest so much into the business of self-storage, not self-storage, the business of self-storage. And, I love the business, though. I know it's just a roll-up door, an empty metal box, but we have 650,000 net rentable square feet that we're currently developing. We own over 2 million net rentable square feet currently. And we have under contract another 500,000 net rentable square feet. So, the surge in prices that we've seen and the surge in per square foot cost for these things have really blown up what we were doing. And that's made it fun, but it's also kind of changed the game for us. So storage is an interesting asset class that has been through a lot in the last 15 years. As of right now, it is the highest performing commercial real estate asset class, 26 straight years. And I do not believe that we will see what we saw in the last 5 years continue with self-storage. I think things are changing dramatically for self-storage, but you have to understand that prior to 2008, institutional money didn't invest in self-storage. There was none. Nobody knew how to operate it. Nobody knew how to manage it. After 2008, we now had models that could test the performance within a credit cycle. That gained national interest in the asset. And then you had big national REITs that created third-party management, and that allowed that that institutional money to deploy that capital without having to run it. That entered into funds, VCs, Wall Street, and everybody in between, which completely changed the landscape. And it also changed the way customers use it, how they work with self-storage, how we get customers. It's almost, like the business of self-storage is, when we got into it, advertising was Yellow Pages. There was no technology at all, right? It was nothing. And so to think of how far it's come is pretty incredible. And it's been a great industry to be a part of.
Hey, Agostino here, and I would love to connect directly with you. Text the word books to 844-428-1111 1344 to receive weekly book recommendations from me. It sounds like there was a transition that took place then, because I've only known self-storage as an asset like you just described here a second ago, very institutionalized, somewhat systematic, if you will. There's a lot of institutional money. There's a lot of money chasing those sorts of deals. I didn't really even look at self-storage when I got into the big commercial real estate deals. For me, it's always been like single family, then multifamily, and that's it. But I imagine it sounds to me like there was a transition point, an inflection point that took place where it sounds like early on, it was mainly mom and pop style business. There was no, what's the orange company there? There's several companies that are not public storage. There was no public storage.
No, when we got into the building, it was like 90% was mom and pop, very fragmented.
Yeah.
Very fragmented industry. That was one of our thesis, that this industry that was fragmented was going to consolidate, and I wanted to be the consolidator of the industry. And that happened way faster than I thought it would. We're at 50% probably are what we would consider mom and pop right now. 3 years ago, that was like 80-something%. The amount of consolidation is, this taking place in this space is literally, it's just like neck breaking. It's going so fast. And the majority of those assets are, you look in first tier markets now, and it's mostly big players, and that's pretty much it in it. And I when I started, like even with the education and everything, about 5 years ago, it was like, this consolidation will take 20 years, right? Now I'm like, wow, we have 5 more years and we're going to consolidate to match probably more like all the other big commercial real estate asset classes. That's how fast it's been happening.
Yeah. Now, do you find you're getting a lot of your investor money these days? Is it from overseas folks, or is it still from local companies or people rather? Because I find that this whole self-storage phenomenon is really something that only happens here in the States. It's not really done so much in Canada, where I'm from. I mean, we do have self-storage in Canada, but not nearly the extent as here in the States. And in other parts of the world, it's non-existent, right?
Yes.
So it sounds like it's an American phenomenon, right?
But that's changing rapidly. And one of the reasons why this was something that I think everybody missed, that seemed very logical to me, was that they viewed self-storage was there because of Americans, consumers, just consumed so much, right? It was like, oh, well, you guys are hoarders, right? When actually that's not what drives self-storage. So self-storage is driven by increasing two things. Price per square foot, so the actual ownership of home cost, combined with increasing regulation. So what we found is that Americans have smaller homes, right? They also have higher regulation. We also have the decentralization of workforce that is very prevalent in America right now. And that spurred businesses. We have last mile, the disruption that happened within the technology space really spurred. We have some facilities that 30% of our facility is businesses. It's not even individuals. Then the next thing that really drove self-storage, its overall demand and what we're seeing is the fact that the internet, the world was flat, but our ability to acquire goods and services got so much easier. So all why space got more expensive, regulation on the space was crazy. When I grew up, you just build a shed on the side of the house when you want to store something. You can't do that anymore. You can't store RVs. You can't store boats. You can't build a shed out there to store your camping gear. You can't do that in America in 90% of the locations anymore. So all of that combined really changed the way Americans utilize space. All of a sudden, a business saying, wow, for me to create, 50 square feet, what's the cost of that, as opposed to just renting it? And Americans are doing the same thing. It's an economic phenomenon, right? And that is starting to spill over. We are now seeing, because of the internet, because of Amazon now going outside into other countries, their ability to have the same things that we have in America, right, is really starting to go up. And we're seeing this in areas that have very high dense populations. Europe now is a big move towards self-storage, and lots of people are very interested in self-storage throughout Europe as it's growing. Canada is very interesting because you have a few families in Canada that basically own the entire self-storage market. So it's a very interesting scenario where you have literally 3 or 4 families in Canada that probably own 70% of the entire self-storage industry.
Wow. But I mean, that self-storage industry in Canada is still fairly small, though, compared to the United States. Or is it?
Compared to the United States, everything, you go outside the United States, it's fractional compared to the United States. It's nothing like the United States. But we're seeing the highest growth rates in other countries in self-storage as they start to adapt it. I think self-storage is a maturing industry in the United States. It's still in its infancy in other countries. But one of the things that we find in other countries as well, like in Canada, the cost and the process to construct self-storage, it's prices we do not see in America in most of the United States. It's very expensive to rent storage in Europe or in Canada. And that has been a pretty big barrier of entry.
Yeah, well, only because, I mean, I can't really speak to Europe, but I can speak to Canada. The amount of taxation, the amount of red tape to just build anything is tremendous in Canada. It's similar to Europe. I mean, they mirror more Europe as opposed to the United States, where in many states there is the same red tape. But yeah, man, I mean, it's the same thing that happens in Europe. And I think if you're able to deal with all that red tape, then it might be a worthwhile endeavor. But it sounds to me like the reason why those families own the majority, the lion's share of that business is just because they've become very, very good at dealing with that stuff. Right?
100%. They have connections with the governments. They know how to make that stuff work. And that's similar to what we see in other countries. I used to live in Brazil, and most of all the industries are, it's oligopolies that the only reason they exist is because of their relationships with the government and their ease to move. Now, obviously, I shouldn't compare Brazil to Canada. That is not the same thing. But in Canada, it's just they understand how to maneuver so well through that. There's a lot of high barriers of entry for individuals to get into an asset class like self-storage in Canada. Whereas in America, for individuals right now to get into self-storage, I believe self-storage offers one of the greatest access to commercial real estate for any individual. You can go buy a 20,000 square foot facility in a 4th or 5th tier market, right? Spend $800,000 and you're into commercial real estate where you don't have major capital expenditures and high cash flow, right? It's an incredible industry for someone starting out to get in. Now, I say that in comparison to other real estate asset classes, right? Now, self-storage cap rate compression has been insane. Funds, VC, everything are getting into it in ways that, are just blow our mind. Because it's consolidating, we very much have portfolio effect. Institutions very big on that. So they're trying to patch it all together, right? And they're looking for stable income, right? They're looking for low risk. They're wanting to easily measure it out. And for the last 26 years, self-storage has provided that. And for most people, see it as continuing.
Yep. Let's talk a little bit about that. So let's cover the COVID stuff first, okay? Because I know that whenever people bring up multifamily, investors talk about multifamily, I always bring up COVID and really and I'll just touch on this. When it comes to COVID and real estate, multifamily real estate, depends on the asset class, depends on the location. There's a lot of how much does the government intervene in the business of the owners, right? So it's a very different scenario in that case. And for the most part, in our case, everything remained fairly stable. We didn't really have too many problems. But self-storage is not the same in that regard. It just isn't, So maybe you could talk a little bit about that. Like how did you guys do and how do you maximize value during COVID?
So, COVID was interesting in so many aspects, but the most interesting thing that was presented by COVID was how the government worked with the markets, how it moved into markets. And like you said, the difference that we saw based upon state was dramatic, to say the least. And it's why we've seen such massive capital flows leaving places like New York or California. And when we looked at this, we look at this capital flow, we look at the migration of people, we look at the growth rates that are caused from it. The areas that we had self-storage exploded. Why? Because people were fleeing certain parts of the country. The exodus that occurred out of, California and New York City during COVID was unprecedented. People were fleeing those states and they were moving to states. And if you had storage in those states, you were raising rates double digit. You were full 24/7. I mean, business was good. It boomed. Our customers were getting paid. Our customers didn't have to work, so they were taking home projects. People were moving. Interest rates dropped, right? Self-storage did outrageously good during COVID. And it put even more of a spotlight on this industry. And it made people really look and say, well, I can't tell you how many multifamily investors that we've had in the last 3 years say, oh, I'm leaving multifamily and going into storage because I want yield and it's easier for me to get into it, right? And they were worried about the government, right? A lot of people did and made that move. And I think it's easy. And as we talk through this, I want to make sure it's very clear, right? I'm probably the largest voice in self-storage, the largest podcast. We have the largest book, everything like that. I am not a self-storage cheerleader, meaning I've also made a lot on the downsides to self-storage and what I think are real dangers in the industry. And I think self-storage has a lot of hubris right now. We're seeing a lot of people just buy to buy because what happened with COVID, the numbers that came out, I mean, our revenues, they really, really went up. And we just saw so much attention turned towards that through COVID.
I mean, and to reiterate, it's a great business because people put their stuff there and people develop an emotional attachment to their stuff.
Yes.
They're not going to just dump it. I mean, they could, I'm sure, but if they don't make the payment, I think it's every 30 or 60 days or whatever, this is not a scenario where you have to evict anybody. You just put a second lock on it. If they don't make the final payment, you put it to auction or something. That's basically the process?
Put it to auction.
So
clean it out, they're done.
Yeah. So from a perspective of dealing with the actual customer, they're not a tenant, they're a customer. It's a very, very different scenario. Yeah.
100%. I tell people,
very different scenario.
I go, we specialize in product customer fit. And people are like, I don't understand. You're in storage. I'm like, yeah, I'm in storage. And I think that's the thing that I love about storage, but I think is also can be the most danger in it. Performance amongst operators are not the same. And the large operators that understand the business, their performance is it is much higher than others. It is a business that is sensitive to operations. Our customers are coming in and out. We have upsells. We do insurance. There's a lot of things moving on in that facility. We can back end other product types, moving companies. We can shuffle around those rates and do things like we do dynamic pricing like airlines do, where every single unit, even if it's the same unit, is getting a different price. And that's shifting around more than monthly. So you can extract yield in ways that a lot of assets just do not provide. It also makes it really resilient to inflation because I can move those numbers so quickly, right? And I don't have to wait. It's just, let's do it. Let's move it, right? And we can adjust, we can adapt fast, and ones that can do it and do it in a way that they can fill up and they can find the customers that can maximize prices. They know what they're doing. They can really get that spread. That's what has made us so valuable and what has made us good is that we were buying facilities. I looked at it as arbitrage, right? I'm not betting on the market to make me. I don't need the market to go up. I'm buying you at this point. This is where you should be. That spread, that is my return. And if the market goes up, that's a cherry on top for me, right? So people that have built these operators, we have over 60 employees that specialize in this. I own 2 tech companies, right? That we can do it in a way that our off-market team, we can identify those that have the biggest spread. We can go buy them, and we can turn those things around quickly and really move. So it's very, very profitable if you can identify and do that. But the thing that makes it great is also the thing that makes it bad. And this is what I think a lot of people don't talk about. They're sensitive. I have seen people at 90% occupancy, and 3 months later, they're at 80. And then I've seen them not fill up. And a lot of people think it's so resilient, and they say it survived the Great Recession. And I go, and so they're like, even if we had a recession, they go, the average occupancy of self-storage only went to 80%. And I'm like, okay, that's true, but revenues dropped in like half. But because what happened with the Great Recession is self-storage operators couldn't get debt. The average LTV for a self-storage facility before the Great Recession was like 45%. So of course they were going to do better. So what they did is we discounted prices. We gave people 3 free months and everything else like that. So it buffered our occupancies, but a huge percentage of those occupancy people weren't paying, right? So it looked good on paper, but I was buying bankrupt facilities, people that couldn't pay their bills, and they were at 75% occupancy, and they couldn't pay their bills. So the thing that makes it great is also the thing that makes it, I think, worrisome to me and scary is how sensitive it is. If you buy a self-storage facility and you pay a 5 cap on that storage facility, and someone comes and builds down the road, and there's just not enough demand in that area, and you drop 10 percentage points, right? Or your vacancy drops, you could see that happen within a month or 2 period of time. It's very quick. And I know people that built thinking that there was demand, somebody else built, and they didn't fill up for 4 or 5 years. So the thing that I love about it is also the thing that people need to look out for and watch out for in this asset class. I'm very bullish. I'm a huge cheerleader for it, but I don't want to be ignorant and act like it's all roses and rainbows.
Right. Oh no, you already emphasized it, right? There's a huge operational component that requires some technical intelligence, not only in the basic operation of the asset in terms of like the smart pricing you mentioned a second ago, installing vending. So you don't even need to have these people, you didn't have to have people there. I mean, technically you can have someone go to a kiosk, book a unit, dispense a lock. The customer can drive over, drop off their stuff, lock it up, and away you go. I mean, there's some great things like that.
We've entered hardware with software. We have keyless technology that people can rent in California on their phone, move into a facility in the middle of the night. Their phone has their gate access, door access, everything else like that. They can move out 3 months later. They'll never even see or talk to another person.
Right. But the key aspect you covered it a second ago was it's still highly dependent on the location, the area, what side of the road it's on, the signage. I mean, the marketing plan, all these different things.
In the market, all sorts of stuff. Yeah.
Yeah. So, I mean, it's not as, like I said a second ago, it's not all like super easy. Just go buy one and that's it. I mean, there's a lot to understanding the business itself.
Yes.
And where and how it relates to the customers in that or potential customers in that local area. So it's certainly it is real estate, but it's not like a multifamily or a development deal or anything else like that, because people need a place to live. They need that. They don't need self-storage, but Americans love keeping their stuff.
Yep, 100%. And we look at it as where is those markets. So how much will people be able to afford? How much will people afford? And the things that I look at that generate self-storage or large macro trends that I think overall the whole world will end up adapting. Population is not shrinking. It is only rising. Space is limited. How we use space is so different from just 20 years ago. Me growing up, right? As a teenager in the 90s, versus now where I live, it's not even the same place anymore. And I think about my kids and my grandkids, what percentage of the population is going to live in high rises in 100 years? It's going to be a big, big percentage, right? How businesses work, the internet, nobody could have even thought when I was a kid, Amazon, things like that. And I'm not old, I'm 37. Right? And we couldn't have even imagined what happened. So when I look at how we interact, how we utilize space, right? Self-storage is a winner over the long run. Over the short run, there's some very big concerns that I think aren't addressed, like its sensitivity to interest rates. So the housing market is a big driver of self-storage, right? So the recession made people lose their houses and it made them have to move. Movement is good in self-storage. Movement's great in self-storage, right? But stagnation, we don't really know. So when I'm looking at markets, I'm focusing on markets, and I think individuals should too, that demand is measurable, it is clear, and it is super strong. Because when you look at interest rates rising and the housing market slowing down, I view occupancy as two different types of occupancy. We have core occupancy, and then we have transitory occupancy. And transitory occupancy is people that are just in there to get from one place to another, right? They're not actually users day to day of the storage. That space is very much driven by home sales. And there's a lot of parts in the country where transitory occupancy right now, I think, makes up a huge percentage of their occupancy. Like it could be like 20%. So if you have rising interest rate, which doesn't like, it's not like people are defaulting on their housing, right? But housing stagnates. So housing sales slow down, right? My question, how's that going to affect those markets? So when you look at markets, when you're going into self-storage, demand is the most important thing. It's not like when you're choosing a place to live and you have all these different attributes. At some point, self-storage is a complete commodity. It's a metal box, right? So oversupplied markets are very, very, very dangerous in self-storage. And that should be the number one concern of anyone looking at it. I have what I call my margin of stupidity. And this is something I started a long time ago. So Warren Buffett has his margin of safety, right? Well, I'm not Warren Buffett, so I have a margin of stupidity. And this is this understanding that I focus so much on demand in the market that my business model will be successful even if I continually do stupid things, because the market will dictate it and it'll allow me to be stupid. There's so many markets right now in the United States, especially for self-storage, it doesn't allow anyone to be stupid. You got to be really, really good. And if you are, that's great. I just don't think anybody's better than the market. And so I look at it and I say, make sure that market can sustain your stupidity. And if it can, great. And that's how I look at it. I invest in places where I don't have to be perfect. Our business plan doesn't have to be perfect. And I will still make money. Everything from there, if I can get it, if I can hit it on top and I can implement, that's great. That's gravy train, right? That's just awesome, which my model really depends on it. Our model is fairly simple. I have 3 years that I want all my money back plus a 20+% return. And then I refinancing that thing and I want to own it then infinitely forever. And that's what we give to our investors. You're in it 3 years, we take 120% out. Then we take cash flow, income, equity forever. And for the rest of, till we have to sell it, because it's either crazy pricing or the fundamentals erode away. But I want infinite returns, but I need that money back and I need it to be working for me, right? So I need to get it back. I need to put it back in the market. I need to diversify it. And I think that's what our investors need. So my strategy is dependent on extracting value. But I have to be able to extract value even when the market's not going straight up, right? These are abnormal times that we live in, and especially in self-storage. So just don't depend on those things to continue, and make sure you have a margin of stupidity, strong demand, and it is a fantastic industry.
Right. I mean, when it comes to demand right now, multifamily rents are skyrocketing right now, yes. Right? So, and I think it's probably your opinion that self-storage rents are just going to keep the same trends, because usually self-storage usually follows, trails behind multifamily when it comes to demand and rents. Does that sound accurate?
Yeah, our street rates are rising like 40% on my portfolio right now.
It's crazy.
We have really good markets that we're in, things like that. But yeah, generally speaking, we see it continuing. But you have to really understand too, self-storage is outrageously localized. 3 miles. 3 miles. Like I can be in a city and I can be 10 minutes away from another storage facility and they could have vacancy and I could be raising my rates 40%. So it's micro strategy when it comes to storage. So overall, for good performing markets for self-storage, good high demand radius, you are going to see continual rate growth over the next few years. In areas that have prolific building, right? Meaning there's been a lot of new supply come onto the market, you're going to see softening. And we already know that there's a few markets. We had markets, unlike a lot of assets. So housing, multifamily is a perfect example. Self-storage is now at the end of a development cycle. 2008, we had retail and housing were at the end of their development cycle. Self-storage development cycle hadn't started yet. There's no money to it. After 2008, self-storage development cycle started. Starting in around 2015, the self-storage industry put out like 3 times as much money per year, every single year, as the past highest ever recorded, 3x it. And that only got bigger, 4, 5x and continual. So self-storage is at a different stage than a lot of other real estate asset classes. And in some markets, this is much more prolific. So when you look at a market that has had a lot of new build, they're just not going to get the rate increases that lots of other places in America is going to get. It's just not going to be there. And rising interest rates, slowing down of housing, those people have to fill up. So they lower prices, they do move-in specials, right? And they got to fill it up, which softens that market greatly. So be very careful on your projections. National averages, things like that don't work. If you're in a part of Texas like Dallas, where they've been building everywhere, right? You're probably not going to get double-digit plus rate increases like you maybe had the prior 2 years. That's probably not going to happen anymore, and you probably shouldn't depend on it. Now, in lots of areas, though, for the rest of the United States, I'd say double-digit rate increases this year, next year are very, very likely to continue over the next 3 years. But it's going to be a tale of 2 cities, like I tell everybody with self-storage. The market performance is going to be dramatically different, where it used to be very even. So across the last 10 years, it was just a rising tide, right? Lifted all ships. I just don't believe the next 5 years will be the same.
I mean, you've seen a lot of success so far, which is great. So what do you attribute the success to? And do you think that success is going to carry you then past the 5-year mark?
Yeah. So, my success in the mode of operating was also a fatal downside. Because if I would have just bought everything that I could have 10 years ago, right, it would have been successful. But we have such high expectation on our returns, and I'm very adverse to risk. I'm adverse to risk because one deal can ruin it all, and there's so much money being made placing capital, just moving it around, right? And I focus on the assets solely, fundamentals. I need to be able to drive revenue, drive those growths, because when we got started, we didn't have investors at all. So we grew over 100 million in assets, just me and my father, no outside investors. And that was because we could increase revenue, redeploy it, right? And keep that machine going. My strategy hasn't changed. So even though the market's gotten tighter, my expectations and strategy hasn't changed. And I keep that. I understand that in times of hyper growth, I'm going to not grow as fast as a lot of other people, but in times of maybe slower or harder times, I'm going to expand rapidly. And that evening out sustainable long-term growth, that's what I'm trying to do. That's my hit, right? There's a lot of people that frankly did in 4 or 5 years what it took me 20 years to do. And that's because they were really good at placing capital and buying assets. So they could just consume, where we focused more internally. Revenue management and location-specific drivers and the business of self-storage. And I think that's made us successful to where we are. We never lost a deal, ever, right? We've never had deals that were underperforming, anything else like that. And I want to keep that up, and we're going to stay and maintain that because I think over the long run, that plays very, very, very well.
Nice. Now, if you had a developer, or rather, developer that wanted to do this business, right? What are some of the things that they should be considering, right? Should they maybe consider working with someone like you or working with you before selecting the type of asset, or rather the area to invest in? Or is this something that you would even recommend anybody take on by themselves?
So first of all, I am a strong believer that self-storage offers the best opportunity of any commercial real estate asset for an individual to get into. And I believe that development, these are the things you need to look out for. So development and self-storage, I think, has allowed people to develop and because it was easy and they could do it cheap. So lower barriers of entry. And I think that those people have, because of cap rate compression that we've seen over the last 10 years, right? They've all been, I think bad deals have been bailed out. Now, when you look at when you're developing storage facilities today, you're 3x higher than 4 years ago. We're putting product out of the ground at incredible rates, but we're seeing assets trade at cap rates and costs that are unimaginable. So, you've got assets that are going for $200+ a square foot. And if I can build for $115 a square foot, right? Is it really riskier to build than not? So how I view it is, if you're an individual that has some land you're sitting on and you don't want toilets, so you want to build storage, that is not a reason to build storage. So we see lots of people that do that. Why'd you build here? I own the land and I didn't want to build apartment buildings, right? So I built storage. That is the worst reason ever. So if you're going to build, demand can't be good. It has to be outrageously good. Your 3-year fill up, right? If you hit a hiccup in the economy, self-storage drives up fast, really, really fast. So when you're looking at developing self-storage, demand is what you need to look at. Your position, your 3-mile radius, how many people are in there. You look at a diversified demographics. A lot of people attribute self-storage to multifamily, but actually the largest user of self-storage is not multifamily. It is homeowners. It's single family homeowners. It's the vast majority of everyone that buys. How I look at it is every single unit is a product. You need product market fit. And this is where you need to work with experts. And you just need to work with somebody that knows self-storage so well. So what they'll look at is they'll look at the area you're developing in. You need to look at all the customers and you need to say, what do they want? Because you're going to develop 6, 7 products, 10 by 10s, climate controlled, RV, drive, whatever that is. You have 10 different products you're selling to a market. You may not choose the right products. It's not like self-storage isn't even, meaning all customer want all storage facility units. That's not how it works. So you need to look at those products and say, what do customers in that area really, really want? And you need to build to cater to their demands, not build just to build. And you don't want to build to just say, let's have a little of everything, right? We see builders do that. That's not what you want to do. And when you look at that market and that demographics, I want to see a lot of different things. I want to see multifamily. I want to see lower starting single family homes. I want to see higher end homes in that market. I want to see income, job creation, and population increase. And I want to look at a low square foot per capita. That amount of diversification amongst homeowners, right? That allows you to have a wider product base within your storage facility and increase your rates and demand. So that's what you need to look at. And yes, you need to get a feasibility study done. And you need to get a feasibility study done by someone that's been in the industry for a long time, has developed out, has owned and managed. There's people that are doing feasibility studies in self-storage right now that have never even done it, never even built storage facilities. So go with the experts, right? Because you can pay them and they can tell you exactly how to do it. And then you can build out a product for $100 or $115 a square foot that you can sell at $200 upon stabilization, right? You don't even need to sell it. You can just refinance, take your money out. And that is a great way to do it.
Yeah. And it sounds like many of those points you mentioned, there's also something that as an investor that wants to get involved with this, or investor that may want to invest in something like this, in a syndication or whatever. Those are the same sort of things they ought to be looking at. And I mean, obviously, maybe not do an assessment or whatever, but at least those points that you mentioned.
I think you should.
Sure. Yeah.
Yeah. Because when you look at it, one of the things that people get wrong in self-storage is they say self-storage demand, there's so much demand here. And then they buy a self-storage facility only to find out that the demand wasn't in 5x5s and 25% of your facilities 5x5s. There was self-storage demand, but not the products that you bought. And so that is a big thing that people get wrong. So all of a sudden, all of their underwriting on that facility is totally wrong. Because they may go, well, look, this market, you're getting $2 a square foot in revenue per square foot a month. Well, this storage facility is only getting $1. I'm going to buy it and I'm going to raise it to $2 a square foot, only to find out that the products that they had and are selling in the market, they're not demand. There's only $1 a square foot revenue. So their underwriting is totally wrong. And that's the biggest thing we see now is their underwriting projections don't actually play out how they think that it will, because they're looking at it like other real estate asset classes. And that's just not how it works.
Right. Well, it's what you said before, the product fit. The product fit has to be
product fit. Demand for each individual. Look at every single unit in there. Look at how many units are in the market, if they're getting rental rate increases, what the occupancy is. Don't look at the facility as a whole. Individualize every single unit. How many do you have? What's the rate on all those units? What's the rate on the units in the marketplace? What is their history on rental rate increases? What is their current occupancy? And how has that played out for a long time? I call this probability. So everybody puts in their underwriting revenue projections. I don't care about the projections. I care about the probability of those projections actually taking place. So every single unit you need to assess what the probability of achieving your underlying projection numbers are. Meaning that if there is availability, right, and if you haven't had rental rate increases, that probably particular unit size has a low probability of hitting it, right? And just take them line item, every single unit, and measure out where the spreads are in the market, availability, how many people are in there, how they're using it, what they need it for, and create your underwriting around that.
Nice. Excellent. Well, we're coming up to that time now. We've got to wrap it up. So tell me, for someone listening right now, maybe they're thinking about self-storage, what sort of bulletproof advice would you offer to them?
Bulletproof advice for self-storage. Adopt my margin of stupidity. Make sure that there's so much demand in that 3-mile radius that you can be stupid and still be successful. That's how I look at it. And I'm like, other than that, all the stuff that you might be scared of in self-storage, meaning the actual tactics, meaning, who do I get to market? Who do I get that, right? You can figure all of that out as long as there is demand. But the best operators in the world can't figure it out if there's no demand. So get into that, focus, and really understand the demand of that local area. And if it's high demand, rising rates, right, there's not enough supply, and all of those things really, really meet it, you're gonna be okay, and you can figure it out along the way. And I think that's the most important thing.
Nice. Love it. All right, guys. If you want to reach out to AJ, you can reach him via his website at selfstorageincome.com. Hope you got some insight on the whole self-storage business. I mean, it's such a vibrant business, a lot to it, of course, a little different than some of the stuff that we usually cover, but regardless, it's still a great place that's certainly positioned for a lot of growth in the next 10 to 15 years. Thanks for tuning in, and I'll see you next episode. Take care.
You've been listening to the Bulletproof Cash Flow Show. We hope you've enjoyed the show. We know we had fun. Make sure to visit our Apple Podcast page and leave us a 5-star review. We hope you've gotten some useful and practical information from the show. For real estate coaching, events, and resources, hit up bulletproofcashflow.com. Till next time.
No information in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this show are limited to accredited or sophisticated investors. Any investments will only be made with proper disclosure and subscription documentation and subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice.